All right, today we're jumping into Hutchison Port Holdings Trust, or HPH Trust for short. Now, their latest report is showing this really big jump in profit. But, and this is the interesting part, the story behind that number, it's full of twists and turns. So let's dig into their 2025 results. So first things first, what exactly is HPH Trust? Well, in simple terms, they're a business trust that owns and runs these huge deep-water container ports in Hong Kong and mainland China. You can pretty much think of them as a landlord for these massive ports. They're like a crucial gatekeeper for global trade. You know, managing the places where all that stuff we buy starts and ends its journey across the ocean.
Okay, let's get right to it. The big headline number from their 2025 report is this, a 12.9% increase. And yeah, on the surface, that looks absolutely fantastic, right? But what is that number really telling us?
So that 12.9%, that's their year-over-year profit growth. We're talking about a profit of nearly 2.5 billion Hong Kong dollars. I mean, that's a huge jump from the year before. But like I said, that shiny top-line number, it's kind of hiding a much more complicated story underneath.
Because, as any investor knows, right, the headline number is never the whole story. It's just the beginning. The real question is, where did this growth actually come from? And once you start to peel back the layers here, well, the picture gets a whole lot more complex and, frankly, a lot more interesting.
Okay, so HP Trust's story for 2025, it's really a tale of two very different ports. What happened with their assets in mainland China versus what happened in Hong Kong, they're just two completely different stories.
And here's the heart of it. The Yantian port over in mainland China, they call it YICT, it saw its container throughput, that's just the number of containers it's handling, it jumped by a really healthy 7.1%, and that was mostly driven by exports. But at the same time, its Hong Kong ports, they saw throughput fall by 6.4%. I mean, that's a huge difference.
Yeah, look at that contrast. That's really the key takeaway here. All of the trust's growth in container volume came from their operations in mainland China. That one port had to make up for the drop in Hong Kong. So that positive number we saw at the beginning, it's masking a pretty big shift happening inside the business.
So you're probably wondering, what does all this mean for investors, for the people who own units in the trust? Well, this is where the story takes another interesting turn, because it reveals this disconnect between the profit the company made and the actual cash that got paid out.
Okay, to get this, we need to quickly touch on two key terms. The first one is earnings per unit, or EPU. You can just think of this as how profitable the company is, broken down for each unit. It's basically how much profit was made for every single unit someone owns.
So for 2025, HBH Trust's EPU came in at 8.59 Hong Kong cents. And just like you'd expect with profits going up, this was an increase from 7.46 cents the year before. That makes total sense, right? More profit equals higher earnings per unit. Simple.
But then we have the second term, distribution per unit, or DPU, and this one is different. This isn't just some number on a spreadsheet about profitability. This is the actual cash the company decides to pay out, the money that goes right into investors' pockets. It's the return you can actually touch.
And here's the twist. The DPU for 2025 was 11.50 Hong Kong cents, which was actually a decrease from the 12.20 cents they paid out the year before.
So this leads to the big question, the one every single unit holder is asking. How on earth did the company make more money, but my payout went down? I mean, it just doesn't seem to make any sense at all.
Well, HPA Trust gave a pretty direct explanation. They said the payout was lower because they decided to hold back more cash. Specifically, they had to increase something called a statutory reserve for that booming Yantian port in China. So it was a strategic choice, Instead of paying out all the extra profit, they decided to reinvest it back into the part of the business that's actually growing. Now, when you look ahead, that decision to pour more cash into their China operations, it starts to make a lot more sense. You just have to see the challenges that HPH Trust itself has identified on the horizon. The whole global shipping world is facing some pretty serious headwinds.
Okay, first up, there are some big trade and policy risks. You've probably heard of the China Plus One strategy. That's where companies all over the world are trying to diversify their supply chains so they aren't just relying on China. And we're already seeing the effects of this. Even with a pause in U.S.-China tariffs, exports to the U.S. from their big China port actually dropped 9% in the last quarter of 2025. And to top it off, Mexico just slapped new tariffs on Chinese goods, which could slow things down even more.
And it's not just trade policy. There are bigger global risks too. For example, economic growth in Europe is expected to be pretty weak, and all those disruptions to shipping in the Red Sea are adding a lot of uncertainty. And then there's the financial side. HPH Trust has to refinance some of its old, cheap debt at today's much higher interest rates. And to put that into perspective for you, they pointed out that for every quarter-point rise in the Hong Kong interbank offered rate, that's HBOR, it costs them an extra 2.4 million Hong Kong dollars in interest every single month. That adds up fast.
So, with all that going on, how is HPP Trust planning to navigate this really complex environment? Let's take a look at what they're saying officially about the future. The company's official line is basically one of vigilance. Management says they're going to be watching these shifting trade patterns really, really closely to try and spot new opportunities and work with their customers. In other words, they're trying to stay agile and adapt to this new world.
And really, this brings us to the final, most critical question for anyone looking at HPH Trust. You've got this one powerful engine of growth, right? That port in mainland China. But the big question is that single engine strong enough to pull the whole company through the slump in Hong Kong and the coming storm of global economic and political risks? That's the central challenge, and that's the key thought we want to leave you with today.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.